Welcome to our High Rock monthly video for December. We are presenting a little later than usual again this month, as we wanted to see how the Bank of Canada's interest rate decision and comments might impact the economy and financial markets going forward. Today, we shall address that, how financial markets performed through the month of November, how our balanced and special mandates were impacted, key adjustments to our models and special mandates, and what we see coming in the new year. I am Scott Tomlinson, and with me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are approaching our 10-year anniversary. If you are interested in learning more about us, please visit our website at www.highrockcapital.ca. Well, first, let's revisit November, which saw most financial markets continue to grow positively. And importantly for most High Rock clients, how our balanced mandates continued their growth. Led by Canadian equities, most equity markets were significantly higher through the month of November. Even Canadian bonds and preferred shares were better, but REITs and continued to languish, and the gold, silver, what we call our precious metals exposure was in a bit of a correction mode, although it's been outperforming through most of the year. Paul, any comments about the month of November?
Well, it was spectacular, driven by the resounding Trump win, and certainly what we saw when he won in 2016 being more pro-business. And that certainly drove the markets and continues to drive it into December 11th as we're recording this.
Yes, and just for everybody's perspective, let's look back over the last 3 years, because it was a difficult time through most of 2022 and into 2023, and markets have responded positively since then. But when we look at the 3-year period, the total returns on an annual average basis have actually been rather modest. So it's always good to have perspective, especially when you're looking at your portfolio, and especially over time. We've had a great year. In all likelihood, we expect that will continue into the year end, which is tremendous. And for balanced portfolios, we look at the Morningstar averages of thousands of balanced funds. But again, you can see that this year, certainly November till now, the 1-year return has been spectacular. But with 2022 being a negative year, and the 3-year average annual return remains subdued. The good news is that over 5 years, things have perked up. So why do we look at this? Well, so our clients can compare their returns against this. And I think that most clients will see that their performances have been at or better than these averages. And that has a lot to do with how well we mitigated the downside during the difficult years. And that allows us to get back to growth more quickly in the ensuing years. And of course, you can throw a couple of great moves in preferred shares. Throw that to Paul, because he found some great value in preferred shares at the end of 2023, and that certainly helped portfolios over the course of 2024. On that note, Paul, do you want to talk a little bit about the special mandates?
Sure. High yield was modestly positive across the month, stable, and again, just harping back to what we've been telling those investors at the beginning of the year, the end of last year, that it would be sort of a coupon year, good coupon year, meaning you just get the coupon or interest income from the bonds. There's not a lot of capital gains left in the marketplace right now, we are moving a little bit more towards a higher cash position. We still have a big weight in energy, which in my opinion, those are show the best balance sheets or credit metrics of pretty much any company that we track. Prefs are kind of interesting, and both.
Paul, sorry,
Yeah.
sorry to jump in here. Just before you move on, I think it's actually interesting because one of the things you say this year is a coupon year, which means that what the bonds that are paying higher yielding interest are basically just that's it. There's not a lot of capital appreciation in the underlying securities, but there's been some continued interest income generated, which is better than 7% on an annualized basis, which I think is something to highlight. But when we go back and look at that 3-year period, the way the high yield performed over that last 3-year period, the total return is somewhat closer to 8%, and that compared to what a balanced portfolio may have earned is significantly better. So there are some very interesting things going on over that 3-year period, very much part of what we talked about, the mitigating of the downside, right?
Yeah, and again, just to highlight that over the last 4 years, we've had a very high energy weight in the high yield mandate. So a lot of those bonds were terribly distressed post-COVID, during COVID, and post-COVID. So that gave us a real boost in our performance. So we thank you for highlighting that, Scott. We had very good 3, 4-year, 5-year performance in the high yield mandate. A lot of it being driven by what at the time were distressed or stressed high yield energy bonds. And as I said, these energy bonds today may be at or close to par, some above par, but they're stable. They're excellent cash flow producers, and their balance sheets are in spectacular shape. And on the pref side, just an update there. And again, this will fall through into the fixed income mandate where we have our prefs residing, or fixed income model, pardon me. Near the end of November, our BMO.PR.Ws were redeemed. We have one bank left, CIBC CM.PR.P for Jan 31st potential redemption. I imagine we'll hear any day now. They typically announce it, 40, 45 days in advance. They have to announce it within 30 days, but given the Christmas period as well, and historically they've been around 45 days. So that should happen any day. But what we are seeing in the preferred share market is quite interesting, is that we've seen a ton of banks redeem. And if you just bear with me, I will tell you how many have been redeemed year to date on my spreadsheet model here. We've had year to date, we've had 4.2 billion taken out, which is roughly 10% of the market, taken out of just out of banks. And then there are corporates that have been redeeming preferred shares. Fairfax just announced they're redeeming a couple. Synovus is redeeming some. So the market is getting smaller and smaller, and the supply is shrinking. There are still some pretty decent size ETFs out there that are based on the preferred share market that have no other option than to continue to buy and invest in these preferred. So that mandate still continues to do pretty well. I'd say the really easy money has been made, but given the dividend income that we are producing out of owning these prefs, and the fact the market is getting smaller, I think it's got a pretty good base to it. So still like it.
And two things. I mean, we've seen a combination of capital appreciation and dividend income to the tune of over 20% over the last year in this mandate, correct?
Yeah.
Yeah.
It's
So
well over that.
that's a pretty good showing, and capital appreciation and dividend income are very tax efficient. So that's another good reason to continue to hold this mandate.
Absolutely.
All right. Well, thanks for that. All good news. Just a reminder to all our clients that our real focus is on your long-term goals. Of course, we want to try and maximize the returns when we can, taking risks when we deem them to be appropriate. But everybody's individual or family strategy needs to be reviewed, and that is our goal as we end this year and get into 2025. We'll want to be updating everybody's strategies. So if you're interested in having your strategy reviewed and updated, please get in touch. If not, we'll be contacting you in the new year to do that. All right, Paul, today the Bank of Canada reduced their policy rate by 50 basis points. I think that's great news for anybody with floating rate debt. And I think it is reflective of two things. One, that inflation has come down very significantly over the last year and a bit, and the economy has slowed significantly as well. So I think going forward, the Bank of Canada has mentioned that they are going to be a little bit more vigilant, and that rate decreases will probably be on a timely basis relative to economic developments. So not as guaranteed to see rates coming down, although from what I read and what I see, we could still anticipate another 2 or at least 3 25 basis point reductions through 2025. Any comments?
I agree with that as well. I think maybe the 50 beeps may be done and gone, and they go 25. I would think, the next 3 meetings, and maybe there's a pause. But the press conference and the statement said they'd be much more data dependent. So a little bit more hawkish, if you will, on further 50 beep rate cuts. So the market has already priced in the Canadian dollar rallied this morning after being hit pretty hard the past few weeks, or even over the past month. So yeah, I think 25 beeps, maybe 3 times would be good.
All right. Let's just switch into our models now and talk a little bit. I'll be brief about the global equity strategy. We have, as stock markets hit their peaks, we have been rebalancing back to even weight with, and in some cases underweight, depending on a client's asset allocation strategy, to take advantage of higher equity prices as we see them. But we also follow a number of metrics, and those metrics are actually rather mixed. Even though you're seeing indices making close to record highs again, those companies driving the indices are quite few. So market breadth, as we talk about, the numbers of companies that are actually involved in that are lessening. So that gives us some reason for pause in looking at stock markets and thinking perhaps that they are a bit overpriced. So we will be taking that into consideration with our rebalancings as we move forward in the equity model. Paul, tactical model.
Tactical. Just really one trade and then one comment. So one trade is we sold our position in BCE, Bell Canada. They made a huge acquisition in the US on some fiber network. I think it was well, the market does too, a massive mistake. You know, the stock was off over 10% that day. But something changed in our strategy for owning this stock. It was meant to be a stable dividend payer. There's a ton of competition moving through the market right now. Freedom Mobile is getting down to, apparently, I just read from a research piece today, dropped from $35 a month to 30. So they've been a real disruptor. So I would classify these Canadian telecoms, including Bell, as slow melting ice cubes as far as their business operations go. And I think BCE tried to get in front of that and show some growth. Well, the business didn't need growth. It was just a dividend payer. So something changed. We sold our stock because of that, but also just as a tax loss selling going into year end. The other interesting thing, talking about preferreds, is what they did when they did this acquisition. They turned on what's called a DRIP, a dividend reinvestment plan. And I believe it's at a 15%, I may be wrong on that, Scott, 15% discount to the outstanding stock price, that you can basically roll your dividends into new stock every quarter. So you think about that. They're going to sell more stock at 15% discount, and can, as well, at the same time, they have what's called an NCIB to buy back preferred shares in the open market. So they're issuing more common stock to buy back slightly more senior preferred share stock, a normal course issuer bid. So that doesn't make any sense to me either. So I'm comfortable holding the prefs, but not so comfortable owning the stock anymore, even though the dividend yield is huge. It's like over 10%. But I'm not so sure there could be a cut to that dividend coming any day. And then, so that was one trade. And the only other comment is Source Energy, which still waiting on a refi for their credit facility and this bond, which our high yield investors still own. I recall we sold the bond at par, 100 cents in the dollar, after holding it for 2.5 years, and bought the stock around $10. That stock over the past 5 weeks or so now has gone from 12.5 to 17.5. It's peaked out a couple times at 18.5, but I do believe once they get this refi done, it'll lead to, quite frankly, I think it's going to, once they get this refi done, it's going to lead to a takeout of the company. On the conference call of the third quarter, I asked the question of the CFO, or the CEO. This company has 45 to 48% market share in the Western Canadian Sedimentary Basin for delivering sand frac and the logistics that go along with that. Like, it's enormous, and it trades at, roughly 2.5 times EBITDA, which a competitor in the US was taken out at 5 times EBITDA. So I don't think this thing gets taken out south of $25 and it's trading at 17.5. I think it gets taken out north of that. As soon as they get the refi done, either a private equity firm or a strategic investor, they've got a JV with Trican, which is a pumper. They could easily buy this thing, and the synergies alone would drop the cost of the acquisition. So I think this is going to get taken out certainly over the next year, but probably sooner. That's that for tactical. Fixed income, I already talked about high yield bonds, preferred shares, government bonds. Quite frankly, the yield on 5-year bonds was unchanged after rising intra-month. It was pretty much unchanged. So investment grade and high yield, government bonds, really, they were kind of flat on the month. It didn't really add a lot of value to our portfolios, and some interest income from both, but pretty flat. That's that.
All right. Any thoughts on uncertainties going into 2025, and if that brings about any change or any alternative strategy that you see?
We should put together our 2025 plan first. You put me on the spot. I would say
Sorry.
we won't be buying Bitcoin at $100,000 a unit. That's for sure. Warren Buffett's been talking about that. That's actually maybe the last point. Just at a 30,000-foot view, I mean, Warren Buffett has been raising a lot of cash, and they've got a record. I think it's over 325 billion of cash sitting there. I think it's the largest holder of U.S. Treasury bills in the world. So the market, it's been a great year, and we're knocking on wood, but you got to feed the ducks when they're quacking a little bit. It was pretty easy to make money for the most part this year, and maybe we performed a bit better than the average balance fund and our balance clients, and obviously we performed well and certainly our preferred share mandate and all, but it's just maybe time to take a little bit off the table and raise some cash, and that includes certainly looking to do some of that in high yield. But in our balance mandates, I just don't think it hurts to raise a little bit of cash. There's always, you never know what the event's going to be to upset the apple cart, but I think at a bare minimum, we might get a slightly better buying opportunity. And I was just reading, Scott, yesterday that some strategists in the US they were all the past year. I think the highest on the S&P was ending the year at 5,000 roughly, and we're at over 6,000. The average was 4,800. So the market just did way more than any strategist thought, which tells you something about Wall Street strategists. And
Exactly.
yeah, so that was a surprise, upside surprise, and you never know, there could be a downside surprise. But one of them I just read yesterday has a 7,000 target on the S&P for 2025. There is always that risk, and who knows with Trump, God only knows what tweet might come out at 3 in the morning. But our what we do is the adjustments we make are always kind of at the margin. We're never going to go all in or all out, that's for sure. And we are a combination of owning the market, which we call beta, and owning some alpha like we have in the tactical model and positions like Source Energy. So that's part of, and the preferred shares, I would say that was a very tactical trade that we can, when the market's going up, we have our kind of more stable global equity positions that can participate in that. And when the market's going down, sometimes we have other positions that are less correlated and can add good value even in a down market.
Yeah, and it's those non-correlated positions that certainly helped us through the down markets of 2022 and early 2023. So that I think is one of the things that we do well, is to mitigate the downside. And maybe it's a bit more of a conservative approach, but in the long run, when you mitigate the downside, you come back to growth more quickly. And I think that's been very obvious for this year.
Yep, indeed.
And we shall continue to follow that path as we go forward. All right. As always, we want to thank you for taking the time out of your busy schedules to tune in. We will be back with our next update at the beginning of January, so not till the new year. Until then, I'm Scott Tomlinson. On behalf of my colleagues, Paul and Diane, we want to wish you all the very best of the holiday season and a happy, healthy, and prosperous 2025.